Welcome to FinTech Guru. Here we are analyzing Indian stock market from its official sources. All the materials are strictly for study and research purpose only. For investments, you have to consult with your SEBI-approved persons or do on your own. Again, welcome to Sarah Presents FinTech Guru. Right, so today we're doing a really extensive deep dive into Natco Pharma Limited, NPL as they're known. Our mission really is to get past the surface level stuff. We want to dissect the core operations, understand their financial health, look at the strategic roadmap, and maybe most importantly, identify the key risks, both immediate and longer-term ones. We've got their latest annual report for FY25, plus some recent research notes and those all-important con call transcripts. Yeah, and the story around NPL is, well, it's quite compelling, isn't it? They talk about being anchored in chemistry skills, and they just wrapped up FY25 with their highest ever revenue, EBITDA, and profits. It definitely suggests that years, even decades, of work are paying off. But for you, the listener, we need to understand how they did it. And critically, is this level of success actually sustainable going into FY26?
Especially with some pretty significant headwinds on the horizon.
Absolutely. And that phrase, anchored in chemistry skills, it's not just marketing fluff. It really is the heart of how they operate. When you dig into NPL's core identity, you find this philosophy where, as they put it, versatility meets innovation. Their stated purpose isn't just about profit, though they're clearly good at that. It's about making specialty medicines accessible to all. And this purpose, this sort of global ambition, it seems to drive their decisions. From which products they choose to develop right through to their legal strategies. It all seems geared towards, well, consistent, profitable, and responsible growth.
Okay, so structurally, how does that purpose play out? Where do they actually focus their efforts?
Well, they basically operate in two main segments, but it's very heavily weighted towards one. The main one, big driver, is pharmaceuticals. That's where almost all the action is, revenue-wise. Then there's a much smaller segment in agrochemicals, which they call crop health sciences.
And the inputs,
Yeah.
the raw materials.
The inputs are basically APIs, active pharmaceutical ingredients, that's the core chemical component, and then the finished formulations, which are the actual drugs you'd buy. The outputs are, well, obviously significant financial returns, but they also highlight impacts on sustainable development goals and stakeholder value. Meeting those tough international regulatory standards is a big part of that output, too.
Okay, let's jump straight to the money then, because that revenue mix really defines the whole risk picture for NPL, doesn't it? Based on the FY25 segmental breakdown, it's not just pharma-dominated, it's overwhelmingly international. What's the exact split look like?
Yeah, overwhelming is the right word. The dependence on global markets is, well, it's defining. If you look at the FY25 revenue numbers from the AGM documents, export formulations contribute a massive 78.6% of the total revenue.
78.6%. Wow.
Nearly 4/5 of their entire business comes from selling finished drugs outside India.
So what about the rest? Domestic pharma, APIs?
Domestic pharmaceuticals bring in 8.4%. Respectable, but clearly second fiddle. APIs, the ingredients, account for 4.2%. Some of that probably feeds their own formulation manufacturing, you'd think.
Right.
And that crop health sciences segment, tiny, just 1.3%.
Okay.
Then there's about 7.5% listed as others, probably other operating income streams.
So the immediate takeaway for you, the listener, is crystal clear. NPL is fundamentally an export formulation company. Its success, its future, it's all tied to navigating those global regulated markets. And the U.S., in particular, looms large.
Absolutely. And the report does mention their reach. It's not just one market. Key regulated places like the U.S., Canada, Brazil, but also emerging markets in Asia and Latin America. They even point out they're ranked among the top 10 generic companies by sales volume in Canada. That's pretty significant.
And that success across different demanding markets kind of validates their strategy, doesn't it? Focusing on these niche products.
Exactly. That's the crucial point. They aren't chasing the high-volume, low-margin commodity generics. They specifically target niche, complex molecules where there's less competition. This is where that core strength, those chemistry skills, really give them an edge. It lets them carve out these profitable, albeit often temporary, market positions.
So how does that niche focus translate into their actual product pipeline, especially for the U.S. market, which is so vital?
Domestically, they say oncology is still the anchor, but they are trying to broaden out into more mass market categories and push deeper into Tier 2 and Tier 3 towns where growth might be higher.
Makes sense.
But internationally, the strategy is almost entirely built around Paragraph 5 filings in the U.S., Para 4 as it's known.
Okay, let's pause there. We should probably unpack Para 4 a bit for the listener, because this is really where the risk and the potential reward for NPL becomes super clear.
Good idea. So a Para 4 filing is essentially a legal challenge. A generic company, like NPL, tells the FDA that they plan to launch a generic version of a branded drug before the original patents expire. They basically argue that their generic won't infringe the innovator's patents or that the patents themselves are invalid or unenforceable.
It sounds aggressive, high stakes.
It is very high stakes. It often leads to complex, expensive patent litigation. But if the generic company wins, they can often get 180 days of market exclusivity. Sometimes they get it all to themselves, sole FDF first to file. Sometimes they share it with other early filers.
And that 180-day window.
That's the golden period. Before the market gets flooded with other generics, they can often charge higher prices and make substantial profits. It's a huge incentive built into the U.S. system.
And the source material shows NPL is actively playing this game. They filed 5 NDAs, that's abbreviated New Drug Applications in the U.S. in FY25. And importantly, some got sole FTF status.
Right. That sole FTF status is incredibly valuable. It maximizes their potential earnings during that crucial 180-day exclusivity. And looking ahead, their current Para IV pipeline lists 28 products. That's a pretty strong indicator of potential future growth if they win the inevitable legal battles.
And looking at the names in that pipeline, these aren't just everyday drugs, are they?
Not at all. It really highlights their focus on complexity. You see major oncology drugs like Pomalyst, that's pomalidomide for multiple myeloma. Then there's Lonsurf, Yondelis, Calquence, Kyprolis, all significant, often very expensive cancer treatments.
Beyond cancer.
Yeah, they're also targeting neurological conditions, rare diseases, things like Nurtec for migraine, and crucially, Evrysdi, which is risdiplam for spinal muscular atrophy. We absolutely need to talk more about that one later.
Definitely. So this focus on technically difficult, high-value molecules, it really defines their whole international approach.
It absolutely does.
Okay, that paints a clear picture of what they sell and where the money comes from. Let's pivot now, Section 2, the physical side. Manufacturing, sourcing, environmental footprint. Where are these complex drugs actually made?
Well, they have manufacturing facilities spread out geographically across India, which makes sense, for risk management and scale. They've got sites in Telangana, Uttarakhand, Tamil Nadu, Assam, quite dispersed.
And given that nearly 80% of revenue is exports, these facilities must meet some pretty high standards.
Extremely high. Every single site producing for export markets has to meet global regulatory standards. We're talking FDA approval for the U.S., EMA standards for Europe, and so on. It's non-negotiable. They emphasize optimizing production using both their manufacturing capacity and their in-house formulation skills, all while maintaining, stringent quality and safety standards.
Okay. What about raw materials and their environmental approach? We know the inputs are broadly APIs and formulations, but the annual report actually goes into quite a bit of detail on resource management, doesn't it? It seems like more than just box ticking.
It does seem that way. The sustainability focus looks quite strong. They highlight efforts to minimize their environmental impact. For instance, in FY25, they state that just over 25%, 25.05% to be exact, of their total electricity came from renewables. Solar and wind.
That's quite significant.
It is. They calculate this avoided nearly 14,600 tons of CO2 emissions. That's not trivial. They also mention actively exploring and using alternative fuels like dry oil cake instead of relying solely on coal.
And water. Always a big issue in chemical manufacturing.
Critical, yeah. Especially for API production. They report recycling over half, 53.11% of their total water consumption in FY25. And maybe more importantly, they've set a goal to achieve water neutrality in their API units in Mekaguda in Chennai. That's quite ambitious.
And waste.
On waste, they state they fulfill 100% of their extended producer responsibility, that's EPR, for post-consumer plastic packaging waste. So yeah, these details suggest a structured approach to managing environmental risks and governance, which is important in such a highly regulated industry.
Okay, let's circle back to that central point, the huge reliance on exports. 78.6% export formulations. That must make them incredibly sensitive to currency swings, right?
No, absolutely. It's a major vulnerability. That high exposure means foreign currency movements can have a really significant impact on their reported profits. The notes to their consolidated financials actually spell this out with sensitivity analysis, particularly the Indian rupee versus the U.S. dollar, given the importance of the U.S. market.
Right, let's break that down. How much profit are we talking about being affected by the rupee-dollar rate? The numbers looked quite stark.
They are stark. The model shows significant operational exposure. Get this. If the rupee were to strengthen appreciate by just 10% against the US dollar, the negative hit to their profit and loss for FY25 would have been around 917 million.
Wow. Nearly a billion rupees wiped out just by a 10% currency shift.
Exactly. And conversely, if the rupee weakened by 10%, they'd see a gain at the same amount. It just highlights how crucial currency risk management is for sustaining those margins they hit in FY25. They manage this partly through their global network subsidiaries and associates in the US, Canada, Singapore, Australia, etc., which handle the international trade.
That strong international exposure sets us up perfectly for Section 3, the actual financial performance in FY25, which, as we said, was record-breaking.
Yeah.
But we need to understand why those numbers were so high.
Yeah, FY25 is definitely a standout year. It looks like a combination of successful launches hitting the market and getting those favorable exclusivity windows we talked about. Looking at the consolidated numbers, total revenue hit 47,840 million. That's up 15.9% year-on-year from about 41,261 million in FY24. Solid growth.
But the profitability, the margins, that's where NPL really seems to shine, or at least did in FY25.
That's the remarkable part. Their operational efficiency seems exceptional. EBITDA earnings before interest, taxes, depreciation, and amortization came in at 25,505 million, which translates to an absolutely massive EBITDA margin of 53.3%.
53.3%.
In generics.
Exactly. Margins like that in the generic pharma world usually point to one or two things. Either incredibly tight cost control, or, more likely in this case, the significant temporary pricing power you get from those limited competition or exclusivity periods. That's the Para 4V strategy paying off big time.
And that flowed straight down to the bottom line for shareholders.
It certainly did. Profit after tax PEI jumped 36% to 18,834 million, and earnings per share EPS followed, climbing from 77.34 in FY24 up to 105.26 in FY25. Big league.
And the driver, still overwhelmingly exports.
Overwhelmingly. The engine pulling this train is the export formulations business. It just reflects how successful their strategy of picking niche products and penetrating markets like the U.S. was, at least in FY25. Okay, let's apply a slightly deeper financial lens now. Starting with returns. Return on equity, ROE, how well they use shareholder money. The consolidated ROE was 29% for FY25.
Yeah, 29% ROE is a really high number. Needs context, though. For you listening, generally speaking, the average ROE for top Indian-listed companies might be somewhere in the 14–16% range. Investors often look for companies consistently hitting maybe 18% or more as a sign of quality.
So 29% is?
It's way up there, nearly double the average for capital efficiency. It suggests they're not just making high profits, but doing it with relatively less shareholder capital invested compared to peers. That's a huge plus.
What about efficiency ratios? Managing operations, cash flow?
Yeah.
Did anything stand out there? I recall seeing a slight improvement in inventory, but maybe a small flag on receivables.
That's right. Inventory turnover edged up slightly from 1.08 to 1.12. That's good, means they're moving stock a bit faster. However, the trade receivables turnover ratio, basically how quickly they collect cash after making a sale, dipped a bit, went from 3.80 in FY24 down to 3.62 in FY25.
So sales are up, but collections are slightly slower. Why is that a potential caution flag?
Well, it raises a small question about the quality or perhaps the terms of those booming sales. A decline, even slight, suggests that sales growth might be running a bit ahead of actual cash collection, mainly from those big international customers. It's not a crisis, but it's something to watch. If sales are strong but cash comes in slower, it ties up working capital. That could eventually strain liquidity, especially for a company so exposed to currency risk. Needs careful monitoring.
Okay, a point of caution there.
Oh.
But despite that, their overall balance sheet health, particularly regarding debt and liquidity, looks exceptionally strong according to the report.
It does. That's a major de-risking factor. The company states they have no long-term borrowings. They fund their needs mainly through the strong cash they generate from operations, plus some short-term working capital loans. Because of this, management sounds very confident, saying no liquidity risk is perceived. They also mention having strategic processes for allocating resources, managing risks, and keeping capital costs down.
And there was that interesting tidbit from the con call about their cash pile and potential plans for it.
Yes, that gave some real insight into their thinking. Management mentioned they were sitting on about 30,500 crores in cash. And then they gave context about a potential big move, this Adcock deal they're looking at. If that goes ahead, they expect the cash balance to drop significantly, down to around up 1,100 crores plus whatever they generate during the year.
So they have the dry powder for major strategic acquisitions if the right opportunity comes along.
Exactly. It shows they maintain high liquidity, partly to be ready for large deals that could further diversify their growth, especially internationally.
Right. That leads us neatly into Section 4, growth drivers and future strategy. Given their whole model relies on cracking complex products and patents, R&D must be just about the most critical investment they make.
Absolutely paramount. R&D is the engine. Their entire future strategy is anchored on innovation. You can see it in the spending. R&D capex was $3.73 billion in FY25, and they project that to increase to $4 billion in FY26.
A rising investment signals commitment.
Definitely. It shows they're serious about keeping that para 5V pipeline filled and maintaining momentum.
And where's that money going? It sounds like high-reward areas.
It is targeted spending. A lot goes into cancer products. Those require notoriously expensive clinical trials. They're also investing heavily in peptides and oligopeptide products. That's kind of the next frontier for complex generics, technically very challenging. And ambitiously, they're also spending on NCE's new chemical entities. That means trying to develop genuinely new drugs, not just generics. They estimate spending $250 to $300 million just on NCE development.
Wow. So moving beyond generics into original drug discovery.
It looks like they're dipping their toes in, yeah. But R&D isn't just about new molecules. They also highlighted process innovation, right?
Yes, that apixaban example was interesting.
It's a great showcase of those core chemistry skills. They developed a new alternative way to synthesize key intermediate stages for apixaban production. And the fascinating part is, a follow-up assessment suggested this new process could potentially cut the overall environmental impact of making that drug by around 50%.
So, cheaper, greener, and potentially gives them a manufacturing edge.
Precisely. It shows R&D delivering value beyond just the next blockbuster drug. It's about building a sustainable competitive advantage.
Okay, now, here's where it gets really interesting. All that R&D, that legal strategy, it recently led to a huge court win. This feels like an aha moment for understanding MPL's whole mission. Let's talk about risdiplam.
Yes, the risdiplam case is the perfect illustration of that mission, making specialty medicines accessible to all. Just recently, the Delhi High Court gave Natco the green light to sell their generic version of risdiplam. That's a life-saving drug for spinal muscular atrophy, SMA. The branded version is Roche's Evrysdi.
And the court's reasoning was crucial, wasn't it? Public interest.
Absolutely central. Roche tried to get an injunction to block Natco's generic, but the court dismissed it, specifically citing public interest and the desperate need for affordable access for SMA patients in India. Natco successfully argued against Roche's patent, partly on the grounds of evergreening. That's where innovators try to extend their monopoly with minor tweaks to an existing drug. NPL's legal team effectively challenged that tactic.
And the price difference, it's just staggering. It really defines NPL's potential impact.
It's almost unbelievable. Roche's Evrysdi cost upwards of 6 lakh, that's 600,000 per bottle.
600,000 rupees.
Yeah. Natco's generic version, expected to cost around 15,900.
15,900. That's what, a 97% price cut?
Roughly, yes. A stunning difference. So this case isn't just one win. It kind of validates their whole model. Use top-notch chemistry, sharp legal strategy, challenge monopolies, and bring affordable alternatives to market. It has huge global implications.
And beyond these small molecule generics and legal fights, NPL is also looking further ahead, investing in advanced therapies, hedging their bets.
Looks like it. They're thinking long-term, diversifying their scientific base. They put $8 million into Agenesis, a cell therapy company. That signals an expectation that these advanced platforms will pay off down the road.
Cell therapy. That's cutting edge.
Very much so. And they also invested $1 million in iStem. They're working on a patented experimental treatment for dry, age-related macular degeneration, AMD, another complex area.
So these investments show they're willing to step outside their traditional generic comfort zone.
Seems like it. Pursuing strategic expansion into new, complex therapeutic areas, while still saying they're committed to deepening their domestic presence in high-growth segments.
Okay. That financial performance in FY25 was amazing. The future strategy sounds ambitious, but it all comes with risks, huge risks. Let's turn to Section 5, key risks and caution areas, because ignoring this part means ignoring what management itself is saying.
Right, and this raises the big question. Can they actually repeat those incredible FY25 margins? Management themselves are sounding cautious. They talk about following a conservative roadmap for growth. Why? Because of macro uncertainties, global industry volatility. Remember, that 53.3% EBITDA margin happened in an industry facing constant, intense pricing pressure.
And those pressures aren't easing up, are they?
If anything, they're intensifying. Payers, worldwide governments, insurance companies are pushing hard for deeper discounts on drugs. This directly challenges the kind of pricing power NPL enjoyed temporarily with its exclusives. Plus, with that massive 78.6% export share, they are super exposed to geopolitical risks. Trade tensions, sudden tariff changes, protectionist policies, any of that could hit their export growth and margins hard.
Okay, let's zero in on the biggest specific risk mentioned in the con calls. Revlimid. Generic Revlimid. This was the drug that drove a huge chunk of that record FY25 performance, right? But its contribution is expected to, well, fall off a cliff.
This is the #1 caution flag. It's why analysts and management itself are being so conservative about FY26 guidance. Revlimid was a massive money spinner in FY25, especially in the first half when competition was limited. Management stated very clearly they expect strong revenue from it again in the first half of FY26. But, and this is the crucial part, they warned the run rate may not continue in H2 FY26. Why? Anticipated pricing pressure.
So why are they so sure the price will collapse in the second half?
It's just the natural life cycle of these para-FYB generics. That exclusivity window, which allowed premium pricing, is temporary by design. As soon as that window closes, or as more competitors get approval and enter the market, which is expected later in the fiscal year, the price for generic Revlimid is going to plummet, potentially quite dramatically.
And management even put some numbers around this potential impact. It sounded quite severe.
They did in the con-call summaries. The estimate suggested this normalization, this price crash for Revlimid, could lead to a potential 20% drop in NPL's overall company revenue for the full year.
20% drop in revenue.
And potentially a 30% drop in profits compared to the peak FY25 levels.
Wow, that's huge. Driven by just one drug losing its premium pricing.
It shows the massive concentration risk. This one factor is so significant that management actually decided not to give specific full-year financial guidance for FY26. They're basically saying, look, things are too uncertain because of Revlimid. We're banking on our other pipeline products coming through to hopefully fill some of that gap. Their immediate future really hangs on navigating this transition.
Okay, that's a major, major caveat for anyone looking at NPL right now. Finally, let's touch on corporate governance and responsibility to complete the risk picture.
Governance seems pretty standard and robust on paper. They have a dedicated risk management committee, processes for identifying, assessing, monitoring, mitigating risks, all the usual structures. Given the high-stakes legal battles and regulatory scrutiny they face, ethical conduct is vital. They highlight their code of conduct, a whistleblower policy, mechanisms to ensure concerns can be raised without fear. Standard good practice.
And their social spending. CSR.
Also seems structured. They spent about $151 million on CSR in FY25, focused on education, health, nutrition, livelihood. They even managed 2 CBSE schools. This kind of community engagement can provide a level of local stability and goodwill, which isn't insignificant in a resource-intensive industry operating across multiple locations in India.
Okay, so let's try to synthesize this whole deep dive on Natco Pharma. What we've seen is a company built on strong, specialized chemistry skills. That foundation led to record-breaking financials in FY25, mostly driven by high-margin export formulations, particularly those resulting from aggressive para-FYB challenges in the U.S. Their future growth seems critically tied to executing on a diverse R&D pipeline, peptides, NCEs, more complex generics, and continuing to win these high-stakes patent fights like the recent Risdiplam victory. But, and it's a big but, the immediate financial outlook is challenging. Shareholders and anyone analyzing the company need to brace for that anticipated hit from Revlimid pricing pressure in the second half of FY26. It could cause a significant drop in revenue and profit compared to the FY25 peak.
That sums it up perfectly. It's a classic high-risk, high-reward scenario, especially with that para-5E model. And building on that Risdiplam success, where the court explicitly prioritized public need over patent protection. Let me leave you, the listener, with a final provocative thought. We know NPL's growth hinges on these complex generic challenges. Given that Risdiplam win was partly based on fighting evergreening tactics, How might the growing global pushback from governments, regulators, health advocates against evergreening and towards more equitable healthcare access, how might that actually shape NPL's long-term competitive advantage against the big innovators? Are they just another generic maker, or are they potentially pioneering a more aggressive, legally savvy, globally focused model for ensuring drug accessibility? Something to really mull over.
That is indeed a powerful question to consider. A big thank you to the FinTech Guru YouTube channel viewers for tuning in to this detailed deep dive today. If you found this analysis useful, please do ensure you subscribe and hit that notification button. It really helps us produce more videos like this for you. And one final, very important reminder. All the information discussed here, based on official company reports, research, and con calls, is strictly for study and research purposes only. For any investment decisions, you absolutely must consult with your SEBI-approved persons or do your own thorough research.